Morning, everybody, and welcome back to the desk of Greg Bodoh. We're going to have a brief discussion today on what are affectionately called REITs, which is an acronym for Real Estate Investment Trust. I get a lot of questions about REITs and how they work, so I decided to throw this into the next segment. You know, a real estate investment trust, or heretofore called REITs, come in two different functions, or two different descriptions. There is the traded REIT and the non-traded REIT. And by that I mean a traded REIT is a listed stock on the New York Stock Exchange, or it could be on any other stock exchange, but giving it the flexibility to trade and having an open market so that you can buy shares and sell shares anytime that you want. Now, a non-traded REIT works differently. A non-traded REIT, exactly as it's described, is not tradable. You invest in the REIT directly with the provider, or the manufacturer of the real estate investment trust product. And when the manager of the real estate sells the real estate, then your money is sent back to you, both profits, if there are some, and the rental income, if there is some, during the period of time that the real estate is operated. Well, real estate is an asset class. However, and I want to mention that real estate is an asset class that is typically non-correlated to the stock market. So what the stock market is doing has no direct relationship to the performance of a non-traded REIT. However, a traded REIT is subject to all the functions of the real estate contained in the REIT and subject to the pressures of the stock market for good and for bad. So I prefer a non-traded REIT because if the asset class is non-correlated to the stock market, then I want to have truly an asset class that's not going to be affected by the pressures of the stock market and only be affected directly by whatever valuation is going on with the real estate. Now let's go a little deeper. Whether it's traded or non-traded, we still have a real estate investment trust. What is that? It's a portfolio of real estate. Different kinds of real estate. Within the asset class of real estate, there are sub-asset classes. An example would be we have apartment complex real estate. We have garden apartment complex versus high-rise apartment complex. We have condo development and sale. We might have shopping center, either strip mall or strip shopping centers or malls. All of those are different types of asset classes. In addition to a REIT, which is a land development REIT. Here's what I mean by that. The developers will buy land in advance of progress, in advance of the development. A perfect example of that might be, if you're familiar with Arizona, the I-10 corridor between Scottsdale and Phoenix. That area between Scottsdale here and Phoenix here has been closing in like this over the last number of years. Now, the developers who do the research on all the environment of that area and all the demographics of that area, they know that corridor is building in, and they know what land is next for development. They might have to wait 5 years, but they know. And there are REITs that actually specialize in buying land in advance of development, in the path of development, holding that land for 2 to 5 years, and then selling it out to a developer who will then take the land and turn it into a shopping mall, turn it into an apartment complex, turn it into roofs of some kind. That's one asset class. There are other asset classes. Let's say within our REIT, it specializes in garden apartment complexes. So in this particular case, the REIT might develop garden apartment complexes and sell them, i.e. for the capital gain, which would be distributed to you, the investor. Or the developer in this case might buy existing garden apartment complexes, add value to them by fixing them up, increasing the rental occupancy, and then selling them out at a higher price. That's a completely different type of asset class. What are the differences? Well, if you're working with a developer who's actually developing the product, developing the garden apartment complex or the shopping center, whatever it is, then you obviously have development risk, construction risk, and all those kinds of things, and rent-up risk. On the other hand, if you buy an existing garden apartment complex, in this example, and it's already rented, it needs some value added to it. It needs some fix-up, some repairs. With the fix-up and repairs, it will then increase occupancy. All of these things will increase the rent rolls or the net operating income of the property, which will make the property of greater value, and then sell it. What's the advantage there? Well, number one, you're going to have a quicker turnaround. Number two, you're going to avoid the development risk, construction risk, and the timing risk of all those kinds of things, and the rent-up risk. At least you're going to avoid half the rent-up risk, because remember, the complex is already rented to some extent. It may be 70% occupied, it may be 80% occupied, more or less, but nevertheless, it is the developer in an occupied property to increase that occupancy to higher rent rolls. So there's examples of different kinds of REITs. I have also seen recently REITs that specialize in medical buildings. Now, when I say medical buildings, don't think hospitals. That's a different kind of product and a different kind of asset class. But think of all the medical buildings that are around your local hospital, where the doctors themselves have their offices, where there might be cardiac support for doctors, all of the different medical support, medical laboratories, those kinds of things. Those go in those extra buildings that surround the hospital. The real estate generally isn't part of the hospital. Those are owned by landlords who have put the properties there so that the medical personnel and the medical businesses can rent them. But they clearly are subject to the fluctuation of volume done at the hospital. You know, you might think that that's a risk. You might think that it's reduced risk due to the aging of America and the increased business in hospitals. You might think, boy, there's a growing field that I'd like to have some investment dollars in, but I don't want to be invested in the medical business. I want to be invested in the real estate business that rents to the medical business. Now, with that said, in brief, that's kind of a look at what REITs are and are not. The rental real estate that exists and has tenants has existing rent. So part of your total return will be the existing rent as distributed to you, which would be called a dividend. And part of your total return will be made up of the capital appreciation of those properties from the difference between when they're bought and when they're sold. If you're buying a land development deal like we talked about earlier, your rate of return will be created nothing more by the difference between the sale price and the purchase price of the real estate. That's a summary. I hope it's not too brief. If you're interested in knowing more about real estate investment trust, the different asset classes, or expanding on any of those, or who they're appropriate for investments, feel free to contact us anytime. 540-347-2125. I'll be happy to speak with you. And in the meantime, happy trails, or in Russia they say, "Das Vidanya," but thanks for listening.